Hello, everybody, and welcome to the Science of SaaS Startups podcast. Today, I'm talking to Johnny O'Dwyer. Johnny is a director with Corbell Capital and a venture partner with Element. Element's an alternative route for technology founders to raise capital without giving away board seats or diluting equity. Johnny, welcome.
Hi, Ben. Thanks for having me.
So just want to kick things off by asking a few quick questions to help the audience get to know you a little bit. So first question is, what item in your house right now do you treasure the most?
What item do I treasure the most? Probably a quiet room away from everybody, particularly during lockdown where we've been all doing a lot of homeschooling. A bit of quiet space is definitely the most treasured thing in the house, I think.
Yeah, okay, so that little man cave you've managed to carve for yourself in the house.
Small, tiny little man cave, but yeah, it's like a fortress away from the madding crowd.
I've actually got a climbing wall in my loft, like I'm a climber, and that's just absolutely perfect man cave. It's up a set of steps, they can't get up there, and it's perfect time.
Yeah, no, I've got three small kids at home, and particularly during the lockdowns. I live in Dublin. It was great to be able to get away from it all and the homeschooling for a bit of a break.
Okay, perfect. So next one is, do you have a strategy in place for dealing with really bad professional news?
Really bad professional news strategy.
When you've had a really bad day at work, how do you deal with that?
I suppose I like to get out and about. I like to just break out and just go for a cycle. I'm fortunate that a small group of us, of guys that I live close by. We do go and do a bit of cycling up the Wicklow and Dublin mountains, and that's a great de-stressor. It's kind of a very good way to unwind and unlock all the nonsense that goes on, particularly when you're wedded to a computer screen much longer than maybe you were previously in this remote working environment. Yeah, I find that's a great way to de-stress and get away from the noise and the frustration sometimes of just being constantly on.
Yeah, I mean, very similar. It's amazing how many ills fresh air will solve, because whenever I have like a deal go south on me and it's kind of really bad, like I go for a run, and that's kind of similar, just clears that mind and get to look at things a bit differently then.
Exactly. Yeah, exactly. It's a great way to get out. I think it's great for everybody. It's really good. Yeah, but that's generally my tool for de-stressing.
And so looking back earlier in your professional career, do you have like a specific memory that you feel looking back now kind of really influenced where you are? Like for me personally, I remember, I think my second day at work talking to a CEO and him taking me seriously and just being like, oh, I want more of this.
Yeah.
Do you have any kind of those type of memories?
Oh, I tell you, I have a lot of them. I have more than a few of them. I suppose I kind of, the early part of my career, I actually studied computer science originally and then discovered I wasn't ever going to be a very good software engineer. So I really had a natural interest in business, and that led me into KPMG, where I worked as in management consulting first, and then one of the partners pulled me aside and convinced me to do accountancy exams. But that was really good training, because what I thought it did for me personally anyway was it gave me, and it put a lot of structure and manners on me, and it gave me a good kind of vista into what goes on, in everything from management meetings and boardrooms in business right across different sectors. That was great for putting manners and a bit of structure in how you think. And I think, you think you know a lot when you're leaving college, but actually your university, you actually know very little, and you are very green. Yeah. And I think there's a big degreening process as you get older and as you join the workplace. So I found that training just really, really good, just brilliant. I mean, I was never going to be the world's best accountant either, but I just found the environment it created and the structure just brought up new ways to learn and get real and how business really worked. And then I think when I left there, I went and worked for very prominent business family in Ireland, and again, I think it was a further degreening, and I remember that was a real eye opener as well, because you were suddenly dealing with real money and making real investment decisions and brevity, and cutting to the chase really, really quickly. And I was very, very fortunate to work for some great people, very senior people early on. And I think you just learn by osmosis, by making mistakes and by seeing how business works in the real world, rather than in a book or in uni.
Yeah, no, definitely. Well, today is a little bit of a change to the usual format for this podcast, because normally we're talking with tech founders and sales leaders. But given the crazy levels of investment into the software industry, I'm really excited to talk to Johnny today, who's coming more from that banking and tech investment world. So it'll be really interesting to hear kind of his perspective on what's happening on the VC world right now. So before we dig into Element and what you guys are doing there, I just want to kick things off talking about the kind of wider financial markets of VC and private equity at the moment. So obviously in March 2020 last year, we saw a very big slowdown in the tech investment sector, which then rebounded fairly strongly in the summer and had a good end to the year. But I think it's fair to say, like, since January of this year, like, things have really gone through the roof. I remember it used to be a fairly rare event when you would get $500 million invested into the software industry in a 24-hour period. But that happens every single week without fail now, and often 2 or 3 times a week. And we've even seen like quite a few $1 billion plus investments. And the number of kind of $100 million rounds plus is just happening more and more. And I think it's on one of those kind of hockey stick curves, which everybody loves. But I just wanted to get your take on kind of where we're at and what is driving this kind of flood of investment into the software industry.
Yeah, like you're spot on it, and it's across every asset class. It's across venture capital. It's across the technology sector, which you and I operate in, and it's in everything. It's in hedge funds. It's in bonds. It's everywhere. And I guess if you really go and look at the root cause and peel back why there's so much money and liquidity in the world, it's really back to, I guess, post global financial crisis in 2008 and onwards. We've had such a very large stimulus of money into institutions. We've had extremely low, ultra low interest rates for a much longer period of time than we've probably ever seen before. And I guess that's the root cause, right? Or the root cause, or when you really double click into why is all this money exist? Why are there so many VC firms around? Why are there so many venture debt funds? Why are there so many private equity funds, et cetera, et cetera, et cetera? It is all back to where the money is manufactured. The money needs to it needs to earn while we're all sleeping. It needs to find the yield. Investment managers, pension fund managers, sovereign wealth funds, and everybody else needs to get a return on capital for us, for our pension funds, and for everything else. And I guess the reason why we're seeing at our end of the market so much volume of work going on and pace of deals and increasing valuation sizes is because there is just so much money that needs to find yield. And therefore, like, there's, I think, across all asset classes, there's just quite a large appetite to take risk, because even down to SME customers that are sitting on cash, pretty large SMEs, rather than sitting on cash and perhaps paying negative interest rates. Well, isn't it better to take a shot and deploy that cash and do an acquisition of some shape or form and put the money to work, rather than having it sit there and not earn? So I think that's kind of symptomatic right across every asset class and every sector. Frankly, it's not just exclusive to technology, although it does seem to be a little bit more exuberant in technology than perhaps in other sectors. But that whole world of money and capital chasing yield is probably the root cause of what's driving everything else. You add to that what we've seen earlier in the year too with Robinhood and the amount of retail money that's come into the market. Again, you've got an extra layer of capital that's going into the stock market And suddenly this, kind of broader democratization of being able to swipe to buy shares and ETFs on stock exchanges, in the US and in every other market. That is all trying to find a home, trying to find a business, trying to find an asset to buy to get a return on capital for the investors holding that money. So that's that's the way I look at it. I think, top down, root cause, it's back to that really low interest rate environment that we live in and have lived in for a while.
So you don't see this as being particularly unique to technology or software then?
I wouldn't say it's particularly unique to technology, although we're probably seeing the bigger, we're probably seeing more exuberance, put it that way. But if you look at capital markets, right? Look at NASDAQ, look at the New York Stock Exchange, look at the SPAC boom, for example, for last year. Like, SPACs have been around a long time, right? These acquisition vehicles to take companies private, blank check companies. There was 250 of those were raised in 2020. This year alone, there's something like 360 SPACs, blank check companies that have gone to the markets, raised money, with prominent promoters, and they're all in the market looking for acquisitions to take companies to the public markets. And that is distinct again from IPOs, another vehicle for taking companies to the market. Yes, the fact that some of them have to be technology companies is neither here nor there. IPOs, one thing that I found really interesting was, I don't know if you remember the .com, but I was coming out of university around the .com, and .com was like, it was IPO mania. Everybody was doing an IPO, and the world is fabled with like pets.com and all these companies that crashed and burned and spent money on expand. Yeah. But like in those .com years, there was something like, 370 odd IPOs done, like around the peak of .com. Like there was 450 IPOs done last year. This year alone in the US is something like 700 odd IPOs. Like that's the kind of, in terms of getting a frame of reference or context on what's going on. And that's not just technology companies. That's all sorts of companies bringing companies to the market and trying to benefit from the very buoyant capital markets and ability to raise money at okay rates.
And obviously the knock-on effect of this is you've got a huge amount of money coming into companies, and more often than not, that's going to get spent on bringing in new skills and new team members and talent into the business. But right now you've got a situation where everybody's getting investment, everybody's fighting for that talent, and there's a kind of an asynchronous kind of perspective on things where you've got a huge amount of money coming in, but still a finite amount of people available to kind of spend that money on. So obviously the logical conclusion is that we're going to see some inflation in salaries. And I think without a doubt in the US, we're seeing kind of major comp inflation in certain different areas, and a little bit of that in Europe, I think, in certain areas. Yeah. But in general, my perspective is that everyone's trying to pay the same or similar to what they have done in the past, and actually just finding it really tough to kind of attract the right talent and the right business. I mean, how do you think sort of founders and even investors should sort of think about that tension between like the huge amount of investment coming in versus the finite pool of talent?
Yeah, I can give you some perspective on it from where we sit in Element. Element typically funds businesses that R&D and product risk is largely not I won't say put to bed, but there is a product that is built, there is customers, there's a couple of million minimum of revenue on the income statement. And it's about how do we get capital to grow, predominantly sales and marketing. And yes, there might be some engineering headcount that needs to be added to the company to do so as well. So we've noticed. So we've seen a lot of we look at a lot of companies in Elements that have got that type of profile. And of course, the capital that we're providing is capital for headcount, therefore. And I would say quite a number of those companies have had to pull back maybe some of the financial forecasts because they can't onboard the people fast enough quickly enough, because of the worlds that you just mentioned that we live in, and that comp is just really high, probably up and down, everything from, depending on, being a full stack developer right up to being a, head of sales or partnerships for a SaaS company or fintech company, whatever it is, that is everywhere. I don't know what you see, but one of the other things that's of interest, particularly looking at it from the Element lens again, that we've got a foot in both markets like you guys, in that we look at US and Europe, and it is kind of thought that there's probably a little bit more. If you look at US and Europe as two kind of distinct markets, we're broadly the same in terms of GDP. Apparently, we've got about equivalent number of software developers. If you're looking at tech, they say there's about 5 million developers in each market. There's we definitely see from some of our customers that development costs in Eastern Europe are, on probably 30% cheaper than they are perhaps in the North American market. So there is a bit of an arbitrage still to play. I'm not sure actually how that works in a post-COVID world, where actually teams, SaaS companies particularly, they were distributed workforces probably pre-pandemic. Now they're even more so, I would say. How is that going to impact salary? So we're in a bit of a, you'll know better than me, but I would say we're probably in a bit of a flux period. At the moment, it's very hard to determine any kind of clear real long-term patterns out of it.
Yeah, I definitely agree with that on the comp side. I mean, a lot of the clients that we work with were kind of remote first anyway, even before the pandemic, and kind of moving more in that direction, if anything. But I think one of the challenges, people are kind of employing in different countries across Europe, but there are still countries where it's challenging to employ people in Eastern Europe and, some of the other countries where salaries might be lower. And there is a bit of perhaps a democratization opportunity for salaries.
Yeah,
it will be interesting to see how that plays out. I mean, in terms of the investment coming into the industry, do you see this as a bubble or a trend that's here to stay? Like, what's your view on that?
I think, look, as I said earlier, I think speaking to some VC friends, I would say it probably finds difficult that the prices and valuations are difficult at the moment to swallow in some instances, depending on what stage of investment. Whether you're really, really early stage, maybe it's not as much of a big deal, but certainly later stage investors, it's quite difficult. Is it a bubble? Who knows? I mean, definitely exuberant. Is it a rational exuberance? I don't know. I would probably say I'd be more leaning into the irrational piece. Certainly. And I know you've probably heard, and heard and read about, a lot of hedge funds and other bigger companies now operating in early stage and later stage private technology investing, like Tiger Global is the one that's frequently mentioned, quite active, so how has a hedge fund come out of nowhere and developed such a prominent position as an investor in technology companies? It's interesting to see again, but like the talent market, like, is there any kind of real markers for longevity in any of this stuff? It's very hard to tell at the moment. We've still got lots of capital in the world. We still got companies that have okay balance sheets on the back of COVID supports and PPP loans and supports. Who knows what's ahead and what way governments need to tax companies and individuals to pay back for COVID. I think we're in a funny period, and look, we're undoubtedly someplace near the end of a cycle, I would say. Is it bubbly? Probably.
Yeah. Okay.
My own personal opinion would be.
I mean, everyone's got to have their two penneth, and then some of us will look really smart at the end, and some of us will look really stupid, right? So.
Yeah.
So if we just jump into Element for a little bit, and do you want to explain a little bit about the world of venture debt and how that's come of age?
Sure. Yeah. So Element was founded by Scaleworks. Scaleworks is a private equity fund that invests, exclusively in SaaS businesses, and has done so for a number of years. Element has Element has come out of the original Scaleworks business, and it came out of needs identified by their portfolio companies, or SaaS companies, who were trying to raise, debt, and trying to raise debt from high street banks, or known high street commercial banks, for simple terms. And in the early days of, when SaaS was really grabbing a hold and that revenue model was really becoming quite part of just enterprise B2B software, I think a lot of financial institutions were probably guilty of not being able to understand the recurring revenue nature of software businesses. So you had like the old school way of on-premise licensing for software, where there was a big check up front, actually, that helped a lot of the working capital cycles for software vendors, and then probably consulting bits thereafter. And that sudden shift, I think, caught a lot of people, and still does catch a lot of people by the wayside. And I guess traditional banks just were not geared to understand, well, jeekers, you've suddenly got this recurring revenue annuity that may not be always contracted. So how do you lend to that, And I think huge frustration by our portfolio companies and the founders of the business to fund that. You're effectively funding very relatively low risk businesses that maybe have a couple of hundred customers, well diversified, rely on the software for critical parts of their business, but yet can't raise capital from traditional debt or venture debt. So they set up the fund out of pure needs and put their own capital and some other family office and institutional capital in to set up a fund to go and fix the problem that they had themselves. And then when you bring that on further, then as the fund developed, and started looking at a lot of venture debt and term sheets, like the traditional venture debt houses. And again, if you're like a relatively new founder or a CFO in certain companies like these, it can be very difficult to navigate beyond the term sheet. So you may get a term sheet that looks good on the front, but then you get into the legals and you find, holy mother of God, there's all sorts of nasty things in here. There's heavy covenants, there's heavy prepayment clauses, there's warrants for equity on top of the interest rates, and they're quite rigid, really, really rigid. And we designed a product that was just super, super simple, that just did what it said in the tin, 3 to 5 years duration, and give a little bit of interest only up front to ease with cash flow. Simple, all-in rate, no warrants. So really try and be what I call the Ron seal of debt. So it does exactly what it says in the tin. It's a term facility over a certain duration at an all-in rate, and that's it. And there isn't anything nasty once you go beyond the term sheet. So that's where the needs of it came out of. Venture debt, it's a really interesting market. It a very well used product in the US for a couple of decades now. Of course, venture capital, it grew up along the venture capital market, where they traditionally funded the servers and expensive actual server kit and equipment, and put asset finance into a lot of businesses. And then it's kind of grown into the industry that it is today, with all of lots of players providing it. And it's well understood, I guess. I think it's better understood in the US market with the founder community than perhaps it is in Europe. You see various stats from time to time about 20% of US venture deals would have a venture debt line in them, compared to something like 5% has been quoted frequently in Europe. But that's changing, and that's changing because Again, back to the discussion we had on capital markets, there is more capital available, skill sets to underwrite technology deals are becoming more commonplace in the market, and the technology to be able to assess them is becoming better too. So the venture debt market is certainly becoming of age, and I think as well, the people that invest, endowments and pension funds that invest in venture capital, for example, are suddenly realizing, well, actually, venture debt's an attractive asset class too, because you get a lot of the exposure to the technology sector, but with perhaps a lot of the equity risk that goes with VC, you get some downside protection with debt because of the nature of the type of product it is. So there's a lot of interest from endowments and pension funds to get exposure to it for their overall portfolio and technology.
You mentioned it's typically kind of more understood or more known about in the US community. I mean, are tech founders using venture debt alongside venture capital, or is it like an either or, like we prefer one direction, or do they use like a mix?
Yeah, it's a good question, Ben. And there is no, I think some people may portray it as being one or the other, and it's not, right? If you're a founder, CFO, CEO, board or shareholder group, what you're trying to do fundamentally is do the right thing for the business. Do the right thing for the business and for the shareholders. And it's not debt or equity. It's trying to get a blend of both so that you average out your overall average cost of capital as a business is reasonable and measurable. Giving too much equity means you take too much dilution and you sell too much shares. Taking on some debt and blending it with the right proportion of equity is a very sensible thing to do. Not every company is suitable for venture capital, and equally not every company is suitable for venture debt. And so we actually, interestingly, we would typically find a lot of companies that may have put in the second, third time founders in some situations. They may have put in some of their own capital into the business to get it going. They have taken a small little bit of venture capital or other capital and got it to a certain proof point. And now they want to bring in some further money to really go on and drive the pre-money valuation for whatever it might be, for the next period of growth. So I would say it's not an either or, but you like being prudent about any business, no matter what way, the growth and demand of the market is, you should be trying to bring in the right blend of equity and debt. Like every big business from DuPont to, General Motors would have for decades, you're trying to get the right blend of equity and debt to kind of blend your overall cost of capital over a period of time.
When you're talking to companies, are you applying the same criteria to a decision-making process as a traditional VC, or does your different business model allow a different decision-making process? And then does that open up different types of companies that you could talk to?
Yeah, it's good. Good question. And I guess it depends on what side you're. Because if you're looking at, I always think back to the racehorse analogy, and trying to explain equity and debt to some people, is that it's, if you think of it like a horse race, the VC or the equity investor is going in really early, taking lots of risk and expects a lot of return for that risk. And in the analogy of a horse race, they really want you to win the race. They want you to become a category leader, break out and be placed in the race 1, 2, 3. They really need their capital because of the risk they're taking. They need you to become a winner. Whereas debt, whether you're banking with a high street bank or a venture debt fund, you really just want to get the money back, right? So you're trying to assess, can you finish the horse race? Can you get around the track and repay the capital, right? So I guess that in very blunt terms, you're trying to, with a debt hat on, you're trying to see, can I get my money back? As an equity investor, you're trying to say, can we generate significant exit here via IPO or be acquired by a trade buyer, a big category behemoth in the space? So that's the kind of lens. And in looking at technology companies, I mean, I suppose we look at it we look with kind of two hats on. You're looking at you've got a nerdy side, which is trying to understand the technology and understanding what's going on in the sector, and can we understand the customer base, and where the market is going, to get a broad gut feel that this is the right place to be. And then you kind of trying to mash that together with some traditional fundamental analysis that you would use on, looking at the financial forecasts, looking at the balance sheet, and doing some of that traditional stuff. And when you get those two things lined up thereabouts, that's where you're going to get a really good fit and match, that this is going to be something we can do.
I mean, just interesting on the horse analogy, because I think a lot of VCs are making a lot of bets, to put it in the horsing analogy, and praying that the one that wins is going to really pay off and pay for all the other bets that they've made. Whereas it seems to me like if you're focusing on the horses that are going to finish the race, then you need to have a bit more of a fundamental understanding. Are they fit enough? Are they going to sort of last the course? So it seems in a lot of ways like what you're doing is a bit more of a thorough approach, rather than I don't want to call it spray and pray, because I know there's a lot more that goes into sort of VC investment than that. That kind of spreading the bets to have the big win.
Yeah, I wouldn't portray it as more thorough, really. I guess it's just different. I guess it's different. It's just you've got different risk appetites, two completely different risk appetites. I mean, when you look at the returns that a VC fund, for example, needs to take, I mean, very crudely, again, this is not an exact science, but like for every euro check you're writing, you would want to be looking for an opportunity for you to be able to return the fund, or do get a 10x return on that, to compensate for the risk at a broader level. So there is quite a bit of science and art in it, all right, but debt is just a different animal, and you're really looking at repayment capacity. I know, like, the companies we're lending to are not they're not always like very predictable in terms of cash flow generation, but we're okay with that risk. We understand broadly the market where they're in. They're not going to be wiped out overnight. Got good teams, good management teams, and really good product mindsets that they will survive. And if they are losing money, they have some prudent, CFOs looking out for the business, so that they can bring things back to an even keel pretty quickly if things go out of kilter, or the market isn't reacting in the same way they expected to the product or the hires they've made or whatever. So there's that kind of little nuance. Again, that's as a venture debt, which is typically it's not taking equity risk, but it's taking a bit more risk than a traditional debt provider. Whereas you're a banker, you're kind of looking for much more straightforward free cash flow generation, like they would look at you and I if we're borrowing money to buy a house and assess our mortgage credentials. Can this guy continue to earn a salary to pay the mortgage back? It's the same principle at the far end of that.
Yeah. Okay. So if we just switch to talking about the kind of startup scene, if you like, and your perspective on that. So I talk to a lot of tech founders and kind of get their perspective on fundraising. But what do you see as the biggest mistakes that SaaS founders make when they're fundraising, and how should they think about approaching fundraising?
Yeah, it's kind of tied. My answer is going to be probably tied back to you'd be surprised, and I'm still surprised, how a lot of companies approach debt and equity in the same way, right? So if you're going to approach a debt investor, for example, don't go with the massive hockey stick and a massive burn profile. That's just never going to match the risk profile of the person you're pitching to. So know who you're talking to, and equally, if it is just about equity and really going big or go home, just know who you're talking to. And that simple thing, I think, is sometimes missed quite frequently. Know who your audience is, know the risk appetite, have some kind of sense for the lens in which they're looking at you. And that goes to talking to an angel investor, talking to a VC investor, and it could be even a strategic VC. It could be a corporate VC who is actually looking at something totally different. They may not actually have any real nous or interest in the actual financials, but they're looking at, well, actually, is this going to fill part of my product portfolio gaps in the next 3 to 5 years? Does my company need to? So just know who you're talking to. And that is just really simple, but just so frequently missed. And I think as well, you're always selling. You'll always be selling, and always selling. You never know who you meet. Unfortunately, serendipity of life has gone in the last year and a half with COVID. But it's always good, I think, to have a warm a deck and warm standby with a good set of reasonable projections and understanding the very basic variables which drive those. And I think don't fob that off on the finance girl or guy. That just as a leader of the business, you need to understand the variables which drive the business. And know what you're going to do with the money. Again, just really, really simple. What are you going to do with it? So have some broad brush understanding for actually where the money can be put to good effect. So I think a lot of people, and there's been a bit of a again, exuberance about announcing or tweeting or gushing about the big fundraise, but actually that's not always that's not always such a great accolade, really. That's, you speak to any founder that I've spoken to in the last 12 months that had a massive raise, there's a lot of trepidation about the next stage, because they know this is just the start. This is the start, and I gotta pay this back either with a big home run or something. They know it's the start. So knowing what you're going to do with the capital is really important. And then the last thing I would just say, which is you're giving up a lot, particularly for founders. You're giving up a lot. You're putting, maybe making some hard family decisions and life decisions to go all in on a business or a startup. That takes sacrifice, and you want to make sure that your sacrifice is remunerated in the long term. So making sure that you don't over dilute, that you don't just go raising cash for the fun of it, that you think about your own personal balance sheet. And I think that's, again, not something you need to dwell on massively, but look at the median ownership percentage for any big company, well-known company that's gone to, say, the market. Like if you take Mark Zuckerberg, he probably owned something like 20 or 30% of Facebook when it went to the IPO. But there's so many, that's very rare. Look at so many examples of founders who've gone and had a sale and might have had, less than 10% in the business. And again, there's a company balance sheet that you need to fund, absolutely 100%. But there's also a personal balance sheet, which you should think about too, which you need to manage, and don't take your eye off the ball on that.
Yeah. And when you're kind of talking to tech founders and you've got your various dials of risk, that you're looking to kind of measure companies on, does how big a variation on that dial does a serial entrepreneur make to a first-time entrepreneur? And if you are a first-time entrepreneur, how do you try and address those risks for an investor?
There's no cookie cutter answer to that one, I'm afraid. I think it really depends on the DNA and makeup of the person in question. And I think any serial entrepreneurs or founders that I've had the pleasure of getting to know over the years, they've been not motivated by money. They've been motivated by solving the problem that they've had themselves, and they're willing to go all in and have absolute singular focus on that one thing, and that one thing becomes the sole focus. And you hear a lot of investors talking about backability, and backability down to the human individual and the mindset, and is and the team that those people can. That is ultimately what the risk is in technology, because the product will change, the market will change, but the team won't change. So what's the DNA and makeup of the team, and what's the risk associated with that? And a lot of people say to you, it's kind of, it's team, product, and market. It's in that order probably too. Get the team and the person and the leadership right. Everything else can weather the storm of a changing market, obsolescence, big competitors, or whatever else comes to whack you on the day in question.
Yeah. Okay. And just a bit of a COVID question, which I was interested to get your answer on, because my guess is, over the last 18 months, you've probably made several multi-million-dollar investments without ever having met the person in person. And I'm just
Yeah.
wondering whether you've ever done that before, like how that
Yeah.
feels. In our industry, we've obviously placed lots of people in companies where they've never met anybody. And I think all of us were wondering how that was going to go, and if that's even possible. But it seems to have all worked fine. How's that been on the investment side?
It's weird, but it's become remarkably natural after a while.
Yeah.
It's been weird. It's where I had done it a little bit before, bizarrely, because I worked in an international business before earlier in my career, and we would have done this, but they would have, one of my colleagues would have known the company at the other side of the transaction, or would have met with them, whereas I would be just facilitating the actual execution of the transaction. In this world, it's become weird, but not so normal now. And I guess the good thing is that everybody's become a little bit more au fait with it as a means and mode of doing business in terms of the practical things and risk, getting access to data. I mean, I would often say that I can actually get access to more data now than I would have previously in an old analog world, going to meetings or find someplace to meet somebody or sitting across from in a room. Yes, you get an extra dimensional edge of just reading body language and chemistry and all of that good stuff, and trust and looking somebody in the eye. But actually getting a lot more data points now, like actual raw data, it's a lot more efficient and things like that. It's definitely no replacement for the common physical touch of meeting people. Definitely not. But I think, like working remotely and remote work and everything else, I think we'll find the pendulum will find some kind of equilibrium where we'll be able to get the best of both worlds, as we come out of COVID more and more.
Yeah. Okay. We touched on this a little bit earlier, but one thing we talked about is, like, we're seeing more and more European tech startups now, and I think the magnet that the US have had for a long, long time in terms of sucking investment and talent across to the US is starting to lose a little bit of its power. How do you see the current scene of European versus tech communities, and what's the kind of future trajectory there?
Yeah, it is. It's early innings, I would say. Early innings in terms of where it'll all pan out. Definitely the center of gravity of Silicon Valley is not going to go away, right? But it's definitely losing a little bit of its appeal. And that's generated by lots of things, like housing is a big factor, taxes are a big factor. Europe is interesting. I mean, Europe is such a fragmented market, really, in lots of ways. I know anecdotally, in Ireland, for example, we have a lot of multinational technology companies here. Frequently hear of a lot of those teams and people moving back home during COVID. I'll be really interested to see how that fizzles out, because there's probably going to be a broader cultural thing to play out too, which is like, if you're not in the office, you're probably missing out on stuff. How do you actually make teams productive when they're remote? And will we naturally just gravitate back into the old world in some respects? Because I think people have probably hit a brick wall in terms of productivity too. First there was a massive boom in productivity on the back of remote working, and that's probably waning now as people are struggling more and more with the mundaneness of not being able to go and meet people, not being able to go on conferences and network and get that energy off people. So I think it'll be interesting to see, but I would say, the demise of the office is greatly exaggerated, and we'll probably see the war on talent become more severe again, because people will drift back into concentrate in cities and in offices again. That would be my own outlook on it.
I mean, it's becoming a real point of differentiation. In the last week, I reckon I probably spoke to about 4 or 5 different candidates who are only interested in office-based roles because they're fed up of working from home and being on their own all the time. But then you get other candidates who love it, and that's a key criteria. They want to work at home, and so it's just a kind of a point of differentiation, I think, now.
Yeah, it's interesting. It's interesting. You know, when the pendulum goes so far out here and then so far out here, we'll probably end up back in here. It's just a matter of time.
Yeah,
so I mean, I think of flux right now.
I think there'll be a mix, because I think there have been companies in the past who've really struggled to find talent in, say, London, where they've got an office, and they now see that it can work if they hire people in, you know, other more regional areas. I think it's kind of proved that model, if you like. But it'll be interesting to see the kind of the balance and mix. I mean, I now kind of work, you know, the odd days here and there from home, and then most of the time I'm back in the office. So, you know, I guess that'll be my sort of natural mix now, but, you know, it'll be interesting to see how everyone else plays.
Yeah. It is going to be interesting. Somebody said to me recently, God, I don't know how I'm going to fit my old life back into my new life. So I think there'll be a bit of that too, you know.
Yeah, there's no space left. So last question, and I asked this to a lot of tech founders, but I thought it'd be interesting to ask you as well. So what would your message be for any kids out there who've got a big idea and no idea what to do with it? Like, what are the best practical steps that can get them on the right path?
Go online and start, and get your mum or dad to, or an aunt or an uncle or somebody in your community to. Just don't be afraid to ask for help. I love that. I don't know if you ever watched that video clip of Steve Jobs talking about when he was a kid, he wanted to play around with some chip or something, and he rang up one of the Hewlett Packard founders. He said the phone numbers were in the book, and he rang him up and he answered the phone. He said, "I'd love to get, you know, whatever it was, whatever chip he wanted to play with," and he ended up getting a job in Hewlett Packard, you know, during the summer. Don't be afraid to ask somebody that you know, because we'll probably invariably know somebody who knows somebody who's in that space, and just give it a shot. And like, it's never been easier to build something, be that software. It's never been easier to, you know, buy t-shirts online and sell them. It's never been easier to do so many things, because the world has become so flat and globalized. It's easy to do a lot of things. Just give it a shot, and don't be afraid to ask, and be brave enough and brazen enough to ask somebody older than you for a favor, because people like to help people.
Yeah, like one of my favorite phrases is "don't ask, don't get." And one of my daughters asked for an ice cream last week, and I said, "No, you can't have an ice cream because you've already had dessert today." But it doesn't hurt to ask. So, you know, don't ask.
Yeah. Exactly. Don't be afraid.
Well, it's been great having you on, Johnny. Thank you for talking to us. So if people want to discuss elements, like, what's the best way to get in touch? Like, are you on email or LinkedIn? Where do you live?
Yeah, I'm on LinkedIn. You'll find me on LinkedIn, jod@elementfinance.com, or on LinkedIn. You'll best get me there. Thanks for having me.
Okay, well, really appreciate your time.
Cheers. Thanks a million. Bye-bye.